Welcome, everybody. It's the next event in our ISA season. Today we have Stefan from BlackRock, manager of BlackRock Greater Europe, as you can see on the screen. I think it's probably fair to say that in last year's ISA season, there were fewer people considering Europe for their ISA. This year, Europe, or in the last 12 months, European equities have performed really quite strongly, and notably this year have outperformed the S&P 500. The reasons for that are perhaps many and varied, and Stefan's going to give us a little bit of a tour of some of those reasons and of his portfolio and how he's positioned for what is quite a fast-changing world in investment at the moment. Before I hand over to Stefan, though, just a couple of small housekeeping things. First of all, if you experience any audio issues, we recommend that you use the WebEx app rather than the browser. The browser may well work, but if it doesn't, it's probably worth installing the app, which doesn't take very long. And then Stefan will speak for about 20 minutes. There's an opportunity for questions at the end. And for those of you who haven't attended one of these events before, you'll see there's a Q&A box at the bottom in the right-hand corner. You can send questions to us. We'll be able to see those. Other participants won't. And I'll be reading those whilst Stefan's speaking. And then there'll be about 20-25 minutes after he's finished for us to go through his thoughts on some of those questions. And with that, I'll hand over to Stefan.
Yeah, thank you very much, Alan, and good afternoon, everyone. Thank you for taking the time to dial in, and thank you also to Kepler for giving us this opportunity to speak to you about European equities today. So my name is Stefan Gries. I'm the co-head of European equities at BlackRock, and also lead portfolio manager of the BlackRock Greater European Investment Trust. And as Alan is saying, we've been doing these webinars for a few years now, and I can't honestly remember the last time sentiment towards European equities was as positive as it is today. This, to our mind, is a big change, as you really only have to go back to November, December last year when sentiment, positioning, and valuation in European equities had fallen to quite extremely low levels. Levels, I would argue, we hadn't seen since the Eurozone financial crisis. And of course, the outcome of the elections in the US played their part there. It led to further capital flows into America after what had already been 3 years of outflows out of our market. And really, at the time, the contrast between the structural problems in Europe and the expected market-friendly measures of the new US government were really quite stark. But as we know as investors, it's usually when everyone gives up and capitulates, interesting opportunities start to emerge. And what we've seen since is that our markets have started, as Alan is saying, quite a strong resurgence. Now, what has driven that? And we'll go into more detail in a moment, but really to start with, we can identify 3 key reasons, particularly for the performance since the beginning of the year. You had the prospect of reaching a relatively timely peace agreement in the Ukraine. We had the elections in Germany that are expected to reduce the political uncertainty in Europe's largest economy, and also leading to a more favorable investment environment and some favorable measures there. And then really, I guess, ultimately, it's the increased urgency that is becoming more visible among European politicians to acknowledge that now is the time to act, now is the time to change, and really work on an improvement in competitiveness for Europe overall. And the package we've seen announced from Germany, the largest really since the reunification, is very significant in that regard, not just as a signal for the rest of Europe, but also as a signal to international investors who are not really expecting such an announcement. So it also helped that our companies have been beating on earnings quite significantly. 70% of companies beat on expectations in the full year results in February. And that meant that Europe wasn't just looking good in terms of early economic indicators inflecting positively, but was also leading the rest of the world in terms of positive earnings revisions. And those are some of the reasons why we've seen the stock 600 now outperforming the S&P 500 for the last 10 weeks, and for more and more capital coming back into our market. Now, to start with, and to give you more detail on this, we just wanted to recap first. And this is one of the points we make to our shareholders, is that ultimately we should never confuse the European stock market with the European economy. Ultimately, we all know Europe is an export economy. We see on the chart on the top right there that 60% of revenues from listed European companies is coming from outside of the region. It's also, to our mind, home to some fantastic businesses that often hold core technologies that are needed for some of the large transformational changes that are going on around us. And yes, we can see there on the top left how earnings didn't grow over a long period of time post the financial crisis. And that was largely because corporates and households spend a long time repaying debt, deleveraging their balance sheets. And I guess investment spend as a result was relatively low. But the advantage you've got is when you follow an active approach, we can focus our stock selection on the areas in the market where we are seeing structural investment spend coming through. And what we can see here on the bottom left is actually that the composition and the structure of the European market has changed quite a lot over that time. And it shows that sectors like life sciences, semiconductors, and capital goods have increased in weight in the index, while some of the lower quality, or what often are seen as older economy sectors, decreased in weight, which is leaving us actually arguably with a much higher quality and a higher growth market overall. Now, what we can also see on the final table, bottom right, is how investment spend had been muted for quite a long period of time, and that is globally. And we can see here now how CapEx intentions and CapEx spend is moving up in all regions, which should really support the earnings of many of the European companies, as that higher investment spend is finding their ways into the order books of the companies we own. And what we should flag here is that those surveys that were done before we had the latest round of announcements on infrastructure and dispense. And what really matters to our mind here is that the growth differential, particularly for Europe, relative to other markets and relative to the US, is narrowing and is coming down, and that's a clear positive. And it means that growth going forward should be really well supported, if you own the right stocks in the right categories that are some of those enablers of those changes, whether it's in defense, in energy transition, digitalization, or the reshoring of supply chains. So for us, this is really a step change. And the good news is that many of these areas that we're thinking about here in terms of spend are in the early beginnings of a change and a transformation that should last for a really long time to come. Now, we wanted to show you this graph to provide a bit more context on that debate, Europe versus the US, in terms of stock markets. I was actually in the US for the elections, and again, as I said earlier, the difference could not have been starker between the two markets. On the one hand, you had this, what was seen as a market-friendly new government coming in, deregulation, animal spirits, and at the same time, actually, I think the day after, the German government basically fell apart, and the entire focus from the international investment community was on those structural issues that everyone sees Europe is faced with. And so we had this phrase coined as US exceptionalism, a widely discussed topic, and the question was, why do you bother with European equities when all of the growth and excitement is happening in the US? And it's true that for a long period of time, US markets dominated, and it was driven by stronger earnings growth that was clearly superior to the rest of the world. But we would actually caution this idea a little bit, and this is why we put this chart in, because when you drill a little bit deeper, you can see how concentrated the market was, not just in terms of leadership, but also in terms of the sources of the earnings growth. And what we're showing here is 12 months forward earnings growth of the Magnificent Seven, the S&P 493, and the Stock 600. And what is clear is that when you exclude the very large technology companies, the US and European earnings look pretty much identical. Now, okay, some of that is history, but what really matters to markets is what is an expectations for 2025. And when we looked at that at the beginning of the year, people were expecting something like 15% earnings growth for the S&P 500, 7 to 8% for the Stock 600. So, that's almost twice the level of growth expected in the US. It was the widest gap we had seen in 20 years. And we think this year is all about earnings delivery. And one of the reasons why we've seen 70% of companies in Europe beating on expectations is because those expectations were much, much lower to start with. And importantly, we think that the earnings revisions are likely to stay positive in Europe as we go through this year, for a number of different reasons we can touch on in a moment. And I guess what makes this interesting in terms of the setup is it still comes at a time where valuations in Europe are at a significant discount. I think it's 25% sector adjusted, when historically that discount has been closer to 10. So there's definitely more to go on valuation too. Now, again, just a little bit more context. We said that we are a globally exposed market, export-driven market, 60% of revenues coming from outside of the region. So we're more reliant on that global growth. And I guess one point that's really important to our mind is that we know there's been lots of talk about deglobalization and reshoring, and of course we've got the tariff discussions as well. But ultimately, we still live in a global economy with global supply chains and trade flows. And this is why we spend a lot of our time and research hours understanding the revenue exposures we are running in the portfolios, which markets we have exposure to, and what is driving growth in those markets in the future. And of course, when we look at that breakdown on the left, in Europe, intra-European trade is important. It's accounting for close to 40% of revenues. And the good news here is that we think that activity levels in Europe are picking up right now. They're inflecting positively, and therefore should well be supporting the growth trajectory of many of the companies, especially in an environment where you put fiscal spend and fiscal programs on top. In North America, you can see it accounts for about 20% of European products shipped. So the US clearly remains an important export destination for European goods. We actually think that the fears around slowdown and recession are overdone. And again, we would expect the next few weeks and months showing that resilience coming through in the data. Now, on China, we can see that standalone, it accounts for 8% of European exports. It's maybe a little bit smaller than most people perceive, but it's still an important export market, particularly for German businesses. Now, the other bit we wanted to highlight here is that from a risk perspective and from a style factor perspective, European growth as a factor still trades at a 25% discount to the highs we've seen in 2021, which again is very different from what we've seen in other markets. And as a result, we think that European growth companies are cheap, they're attractively valued, and that combination of growth starting to reaccelerate at a time when interest rates are coming down faster in Europe makes for a really interesting setup as we go through this year. And that's really our base case, one of continued recovery across different segments of the market. And this is why our portfolio remains pro-cyclically positioned. And we, as I said already earlier, we see earnings of cyclicals continue to surprise positively this year. And that's despite all the noise we're currently seeing and all the negative headlines that we're confronted with on a daily basis. Now, one of the reasons why we do have that view of cyclical earnings coming through better is that we think that China will be much less of a headwind this year. And we put this chart in just to give you some context on what happened in 2024. Now, if we wind back to 2024, at the beginning of that year, really the expectation was for economic activity to pick up in the second half and earnings to improve as we move to the second half. And in fact, that's also how the market traded. So you saw cyclicals trading quite well in the first half. And then from July, August, the data started to disappoint. And we saw more of a shift towards defensives in the summer. And this table here shows the headwind that China posed to European earnings in that period. We're showing consensus forecasts for the MSCI Europe from the middle of last year. And we can see how about 3 to 4% of earnings was lost to China alone, and really had quite wide-ranging impacts across some of, again, the older economy sectors like autos, energy, and chemicals, which suffered as that Chinese demand came through weaker than expected. But it also impacted some of the higher quality consumer stocks, like in luxury goods, as we saw that normalization of the very strong growth we've seen post-COVID, and also more in general retail. Now, we said earlier, China is about 8% of European exports. It's an important export destination. And you should understand that the sensitivities are such that every 1% extra global growth translates into around 9 to 10% of additional European earnings. So it really matters. China really matters. And what is important here is that we are definitely starting to see signs of stabilization. The property market is stabilizing, which is important for Chinese consumers. We've started to see it coming through in the results of some of the luxury goods companies where Chinese consumer spend came through better in Q4 and is expected to come through better in Q1 as well, in the likes of Richemont and Hermès. And we got the same message from some of the large industrial bellwethers like Schneider, ABB, and Siemens, who basically are now talking about their shorter cycle industrial automation businesses in China, finding a floor and expecting a recovery over the course of this year. So we actually think that the coming weeks and months should see further evidence of that activity picking up. And it's partially going to be helped by government initiatives, which means that actually when we think about China more broadly, we believe there's potential for it to turn from a headwind in 2024 to, at least on a temporary basis, a tailwind for this year, and that's still to come through. Now, one of the questions that we get most frequently right now is, why is this newfound optimism around Europe going to persist, and why will the stock market continue to outperform? And I guess ultimately this is what is of most interest to you, the listeners of this webinar, because you might be thinking about what to do in the new ISA season. And I guess the first point to make is we also don't have a crystal ball, and we don't know exactly what the future holds. But what we do believe is that there are a number of building blocks in place for the momentum to continue, and it's not a short list. So to start with, we think that positioning remains negative, with most investors still underweight European equities. We have seen inflows year to date, but those have mostly been into passive vehicles, so ETFs. And importantly, when you look at the total numbers of money that has come in, I think it's about $20 million, it dwarfs in significance when you look at how much capital had left Europe post the beginning of the war. We're talking more the upper end of $150 billion. So there's still a lot of room for money to come back. And I can tell you in conversations I have with CIOs and clients, the skepticism remains really quite high. And I think that is a second important point. Skepticism towards the region remains at elevated levels. And that's mainly because investors continue to focus on some of the well-discussed kind of structural problems that Europe has. And we don't really expect those to disappear overnight. But what is very clear, and we've been talking about this for a few weeks now, is there clearly is a greater sense of urgency among European politicians that now is the time to act, or you risk of being left behind permanently. And it was really interesting to see how Germany is leading the way in that context, starting to address and starting a process to address some of those issues, like the energy infrastructure, digitalization, more defense spend, all of those things. And what it means, and I think this really matters for markets, is that, again, the growth differential in earnings between Europe and the US will come down significantly. And I guess the most simplest way of looking at it is you have the largest economy in Europe expanding fiscally and quite significantly so at a time when the US is doing the opposite and is looking to save and rein in costs. So that's quite a positive. We think that looking forward, the potential for earnings surprises continues, and it'll be helped by some of the domestically driven sectors as well, like banks, construction, and defense. Those revisions should stay positive because they will ultimately benefit from that fiscal spend coming through. And if we want to finish off our list of positive catalysts and building blocks, clearly we're yet to see a conclusion of a peace agreement in Ukraine. That should then, when it comes, should lead to lower gas prices for the European industrial complex. Again, very significant. We should see more evidence of that China growth improving, turning into that temporary tailwind. And again, the valuations in Europe remain appealing. So quite a lot of reasons here, each and every one of them quite significant in their own right. But this is why we think that outperformance we've seen has the potential to continue. Now, I need to speed up a little bit. We wanted to talk about some of the opportunities we are seeing in the portfolio right now. One of them is clearly in European luxury goods. It had a difficult year last year, but we're taking a cyclical risk in that part of the market because we're also very positive on the sector medium to longer term. What is important here is you have to back the right companies. You have to back the winners. I know it's an obvious point, but we have seen a huge difference in performance between individual brands in the sector in recent years. So it's really about backing the management teams that are managing their brands really well, drive innovation, invest very smartly in recruiting new consumers to their brands. Scale is really important, particularly when it comes to marketing spend. Why do we like the segment? And we can see that on the top left, because the industry typically manages to grow 3 to 4 times as fast as GDP growth generally. And we're addressing a segment of society that is very inelastic when it comes to consumption and also tends to continue to spend when the economy softens. And Hermes and Ferrari are really good examples in that regard, where even in a difficult year last year, they still managed to grow in double digits when it came to sales and earnings. Now, one of the questions we often get is, aren't some of those brands like an Hermes, Ferrari, Richemont overexposed? And I guess what we look at is, and you can see this on the bottom left, we look at how fast those ultra high net worth cohorts are growing And we've seen studies that if you look at time period 2023 to 2028, in China, we're seeing growth of over 40%. But even in mature markets like the rest of Asia, Europe, and the US, we're still talking over 20% growth in those ultra high net worth cohorts. And that's ultimately where the new consumers are going to come from. We're often quite surprised by how underrepresented the companies are in some of these bigger markets. Last year was very unusual because you had China, Europe, and US all are down at the same time. We don't think this is going to continue. On the contrary, right now, these markets are inflecting positively. I'll skip some of these slides just in the interest of time. I guess the second area in industrials where we're taking more cyclical exposures in the segment of electrification, energy transition, where we're seeing sizable investment spend coming through on a long duration basis. When we think about electrification of our economy, again, we're in the early stages of development, and it's probably one of the most predictable secular growth opportunities in the market we're seeing right now. Two or three segments within there that are particularly interesting. So in energy management, we own companies like Schneider Electric who offer solutions that help making offices, public buildings, and hospitals more energy efficient. Demand for those type of solutions are often also driven by regulation and the desire of shareholders of publicly listed companies in particular to understand what the emissions are of some of these listed companies. 40% of emissions is coming from buildings. So this is why there's so much investment going in. On the infrastructure side, we see large investments in medium voltage solutions. That's all about making power grids smarter, more energy efficient, and making them capable of dealing with the loads that are coming in from renewable energy. The reality here is that most utility companies didn't invest for the best part of 30 to 40 years. And we now see power demand and power consumption moving higher. And so the demand is coming through strongly. We also see very strong demand for data centers and network businesses, which is an area that Schneider is very strong in. It's about 20% of the group. And that part of the business is particularly accelerating because it's all about how we use data and how new applications like the Internet of Things, 5G, generative AI, and Industry 4.0 are really data generating and data consuming technology. So there's a lot of debate on this at the moment in markets because we see new AI technologies coming through and people think they're less power consumptive. But we've now spoken to ABB, Schneider, and Eaton in the last few weeks. The CapEx budgets of their clients are coming through really strongly, and they think that this part of the market will grow on a double-digit basis well into the next decade. And so we actually think that these topics I've just mentioned will be part of the investment narrative for most of our investment careers. Now, very briefly, to give you a very quick sense of the philosophy of the fund before we start with the questions. So this is really, I guess, a best ideas fund for Europe. The objective here is to deliver long-term growth in capital. We are basically looking at our addressable universe of over 2,000 listed companies, and we build a portfolio of what we think of the 30 to 40 most compelling investment cases that Europe has to offer. That means we often end up with a relatively concentrated portfolio that invests in some of the best businesses in our region. At the moment, we are 32 stocks. And ultimately, we want to align our shareholders' capital with companies that we think of as wealth creators. And so we are very clear on our stock picking criteria. Our companies have management teams with a very clearly defined strategy for value creation. They typically generate high returns on capital. They generate a lot of cash, and that then provides the optionality for them to invest in growth projects at high returns. And so we really spend a lot of time carefully selecting businesses where we align the trust with income streams and end markets that have the potential to generate significant value for shareholders over time. And that brings us to some of the businesses I mentioned, where we think of them as enablers of some of the big changes that are going on around us. And we actually think that Europe has a lot to offer when it comes to these areas: artificial intelligence, energy transition, digitalization, and latterly also in defense, which we've been adding to the portfolio. So there's a whole host of businesses that fulfill those criteria. It's a low turnover fund. Typically, we turn over 15 to 20% of the portfolio. So our minimum holding period is 5 years, which is also an important consideration when we put new ideas into the fund. Alan, I will just leave it here because I know I've overrun already time-wise, and we can turn to questions.
Thanks, Stefan. That's great. What I wanted to start with was just to take a bit of a step back, because as we discussed at the top of this webinar, Europe's been off people's radar for a while, perhaps, and yeah, you noted some institutional fund flow numbers that show that, but it may also be true of retail investors. So when we look at, if someone's coming back to Europe now, I think I'm right in saying that if you'd looked at the index 10 or 15 years ago compared to now, and this is pertinent to your observation about the valuation discount, it's a very different index, isn't it, to where it was, and perhaps you could even argue that the discount is wider. But you just want to talk about how what the index. I know you're not in the business of selling the index, but the index is harder to beat now, arguably, isn't it, than it was. So it's quite an interesting change.
Yeah. So I guess we made that point. So how the composition of the index changed, and I guess as I mentioned earlier, so what we have seen is some of these older economy sectors reducing in index weight, and some of the higher quality, higher growth sectors coming through more strongly in terms of the weight. But even if you look at it on a like-for-like basis, and so let's say you take in a company like Novo Nordisk and you compare it to its global peer Eli Lilly, at the moment there's like a 2 times difference in terms of the PE multiple. And there's some company-specific reasons for that, but the premium is still way too much, considering that ultimately they're servicing the same end market, have got the same growth prospects. Arguably, Novo's got the higher quality accounting, higher return profile, and all the rest. And we can see that across a number of different segments. We see it in some of the industrials. You can definitely see it in some of the banks. So it's massive skepticism still regarding European banks. They used to trade on 10 times earnings pre-financial crisis, when arguably at the time the returns are much lower than what they are today, and shareholder returns were much lower than what we're getting today. And so there's still a huge amount of skepticism priced into some of those valuations. And then I guess if I think about some of the other segments, construction, we've gone through a downturn of 2 to 3 years when interest rates were really high, and now we're starting to see that inflecting. And what is really interesting in that regard is that when we speak to some of the companies, so we had the CEO of Holcim in our offices not so long ago. It's not a stock we own in this trust, but he made the point that Germany should be building 400,000 new houses per year. At the moment, they're building 180 to 190. So it's a structural shortage of dwellings. And actually, we can make the same point in the UK, and we can make the same point in France. And so there's quite a lot of different segments where we feel quite good about the outlook going forward.
Yeah, thanks. And I know you've been looking forward to the question about tariffs, which has obviously come up. And I think everyone watching this can forgive you if some of this is, I think we can acknowledge that speculation is part of part of this, but there are some concrete things you can start to look at
Yeah.
and think about probabilities, aren't there? So do you want to talk about some of the positive sectors and companies where you see that 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 they should be relatively immune, and
Yeah.
also some of the sectors and companies you're avoiding?
Yeah. Yeah. No, absolutely. So, so there's a couple of points, and actually maybe I'll refer back to my comment earlier. We don't have a crystal ball, and thank you for your kind introduction in that regard. So, but I clearly the first observation is actually that every year you do this job, and every year an investor or retail investor, professional investor, doesn't really matter. There's always an element of uncertainty, and there's always an element of risk. And there's always different things to worry about. And it's clear this year it's a bit noisier, and we've got a lot of announcements to analyze on a constant basis. And when it comes to tariffs, I guess we have been looking at this pretty much for almost like the last year in the run up to the elections. You make sure that you try and understand how individual sectors are positioned. And it was clear that in Europe, one of the sectors that will be in the crossfire is the auto sector. But what's interesting in that regard, Alan, is that actually when you look at the relative performance of autos, they troughed in December. So the market prices in these risks really quite quickly. Now, the biggest risk for us right now on the tariff policy is the constant change and back and forth, because what it does is it creates uncertainty and it lowers confidence, and that, if it persists for too long, could impact, lead to a growth dip for a period of time. Now, the bottom line is that ultimately you want to avoid low gross margin businesses with little pricing power. And what helps is to own companies that have pricing power, that might have some production in the US, that have high gross margins, which means they can pass on any of these impact, or in the first instance might not be as affected as people think. So again, when we think about a Schneider, they will have local production, and the same is true for some of our other industrial companies. And for the luxury goods companies, nobody wants a handbag produced anywhere other than Italy or France. But these companies, have really high margins and a lot of pricing power as well. And so the impact will be much less than what people feared in the first instance. The other bit that we learned by speaking to experts and also the businesses is that the tariff is placed on the transfer price. So it's not 25% on what the selling price is in the shop. It's basically 25% on the production value that is passed on from Europe into the US. And so again, the overall impact is smaller there. But what it comes back to is you need to do your homework, you need to be all over the numbers, and you need to understand the impact. And that's where following an active approach and having a big group of analysts around me can really help to make sure that we avoid the businesses that are most impacted. And I guess that's what we're aiming to do. The other bit is that we shouldn't forget, that's maybe the last point, is what complicates the analysis is nobody knows how long the tariffs are in place for, because we've already seen delays in implementation. And so that, I guess, is one complicating factor we just have to we have to be mindful of and stay very close to, because they could also be reversed relatively quickly. So yeah, those are some of the thoughts on the tariff side.
Yeah, and similarly, the geopolitics is a great word to mean an awful lot of things, isn't it? But yeah, the kind of mantra of European equity fund managers for a long time has been, don't worry about the politics or the geopolitics, it's all about the companies.
Yeah.
And arguably in the last 6 months, geopolitics has shone a light on Europe, and investors have started to take an interest. So that doesn't mean that it translates to performance in companies. But what else? Everyone's very, very focused on tariffs and what the US is doing. Is what other risks are
Yeah.
there that you think about outside of what everyone is focused on?
Yeah. So no, that's a good question. Now, but maybe if I can just pick up on what you said there, because so you get these periods where it's top down and macro headlines being traded more than anything else. Yeah. So like at the beginning of the year, like very popular trades were to buy Ukraine recovery baskets, and they consist of cement companies, chemical companies, and other construction companies. And then then it was about banks and defense companies because we saw all the announcement on the defense side, and that's all good and well. But we mustn't forget that ultimately it will all come back down to earnings and valuations, and that stocks follow earnings over the medium to longer term. And so whatever you see in terms of share price moves has to be backed up by what I talked about earlier, positive earnings revisions and re-accelerating growth, because otherwise that's not going to work. And I think we'll find out that some of these areas that have been bid up year to date will probably have some disappointments because the numbers won't come through in the way that the share prices would have suggested. And so that's why we need to be quite careful. Now, other things that matter from a risk perspective. So, we keep an eye on inflation more generally because we do think we're on a normalization path when it comes to inflation. And we've already started to see the ECB leading the way in terms of rate cuts. But I guess what wouldn't be helpful is if any of the actions we've seen are leading to a resurgence in inflation. I think that would be a negative both for growth, but also for markets more generally in terms of rates and valuations and so on. And again, actually, what sometimes helps is to look back 2018, 2019, when we last had a trade war. Because right now, it's very easy for everyone to say, right, it's obvious tariffs will be inflationary and growth will come down. Well, I guess if you look back to what happened 2018-19, you see all the mitigating and offsetting factors. You see currencies adjusting. You see, again, some of the trade flows rerouting through countries where the impact is less. You see pricing coming through. And so actually in 2018-19, you didn't see a pickup in inflation on the back of the tariffs that were imposed. And so the jury is still out. And so we would caution to kind of come to that conclusion very quickly. But we need to make sure inflation stays well controlled and that we remain on the path that we've been seeing. I guess the other bit would be like if the uncertainty and the noise continues in the way it maybe has done in the last few weeks, there is a risk that some companies might just say, okay, we'll just hold back investment for the time being until there's more certainty. Now, that is a tangible risk. This is where it helps when you kind of are aligned to some businesses and end markets where the spending is coming through really strongly regardless. And I guess the second observation we would make is that, yes, we're seeing a lot of actions being taken, but we also do believe that ultimately the Trump administration does not want to be remembered for taking down the US economy, bringing back inflation, lowering growth. I think there will be a degree of pragmatism at some point where they think, okay, actually we do care about the stock market, we do care about the companies in America, and we want them to do well. And so, I guess that's part of the thinking there as well. And I guess Europe has a job now to step up as well, and kind of that'll be really interesting in the coming weeks and months. And I think the German program, which should go through Parliament today, is the first step of a process that has the potential to take a number of years to come through and should ultimately be supportive for growth again in Europe as well, because money will be going into infrastructure, the energy markets, healthcare, defense, all of those areas, and that should be a positive for growth in the largest economy there. So there's a few things I guess that come to mind. Usually you always have one or two things that come out of the blue that nobody had on their card either, and I'm sure we'll be learning about something completely new in 2025, just as we've done in previous years.
Yeah, and I think you've kind of hinted at part of the answer to this question, but one of the viewers is asking about borrowing costs as rates are coming down, but obviously UK government borrowing costs have risen, and so have German borrowing costs, and what you just outlined, that a lot of that borrowing is borrowing to invest rather than borrowing to spend. But do you just want to give some thoughts on the risks of higher borrowing costs? Because I guess there's a lot of companies who've been waiting to refinance, having seen rates go up, and maybe that's being snatched away from them now. I don't know.
Well, this is a really interesting question.
Like?
This is a really interesting question, because actually I remember already kind of post-COVID and like from 2022 onwards. So in 2022, when we had this step change in borrowing costs, and we like in 1 year saw a really big increase in borrowing costs, there was always this boogeyman out there saying, no, we'll hit a wall of refis in 2024, 2025. And to be honest, it hasn't really happened. And part of the reason why it hasn't happened is that we now have private credit markets that are very happily financing some of these companies, but also because actually we have started to see borrowing costs coming down. And you saw it in Europe. The UK and the US are a bit behind and also moving a little bit slower. But I guess the other observation is that, like as I said earlier, a lot of European corporates and households actually spend a long time deleveraging, and so the starting point of the leverage and the borrowing was much, much lower. And a lot of those segments of the economy are in a much better financial health, and so it does actually, to our mind, ultimately come back to confidence of consumers and businesses to say, no, now is the right time to spend money on consumer goods, or now is the right time to invest in that new plant. And I guess here, what's important for Europe is, and has to be part of the healing process, is to make sure that the incentives are there for businesses to invest locally. Because if you're, let's say, a board member and you have a discussion, like a DAX company, and you're discussing where to build the next plant, well, you've got lots of different options, and there has to be good reasons to put it into Europe. And I think that has to be part of Europe becoming more competitive, to make sure the energy costs are competitive on a global basis, to make sure there's less regulation, which has been a big burden. And that's actually one of the things, when I said earlier, greater sense of urgency and a better understanding. When obviously you had the Draghi report last year, which was quite damning, outlining all the issues. You also had a FT article written by Lagarde and von der Leyen, outlining all of the issues and what needs to be addressed. And this is, I think, what has been sinking in the political elites in Europe. We need to change, otherwise all of the money is going to the US, all of the investment is going to the US. And I think that is the change we're seeing, and we'll see more evidence of that in the next weeks and months and years to come.
And whilst I know we've gone a little bit over time, there are a couple of questions about defence, and I think it's a good question with the share prices of the sector having risen so strongly.
Yeah.
And I know you're somewhat constrained in what you can say about individual stocks, but do you want to talk a little bit about some of the challenges and opportunities of as an investor in capturing some of that, and what you'd like to see, how you'd like to see the picture becoming clearer?
Yeah, I mean, it's obviously like this again. It's a step change. The spending is going to step up and stay high. And to be honest, you've seen these periods where the ceasefire was talked about before, and a lot of these companies came back quite significantly, at least for a short period of time. And that was quite short-sighted, because I think it's quite unlikely that even after peace in Ukraine has started, that companies will or the countries will go back to, I guess, in what we've seen in the last 20 or 30 years. So the change is here to stay. And then I guess the question is, how can you reflect it in portfolios in an ethical and the right way. I mean, we're trying to stay away from companies that produce ammunition and some of the other equipment. But then there are opportunities for us to capitalize on, sometimes indirectly, sometimes directly, and we've been reflecting them in the portfolio as well. And to be honest, the reason why we've done that is because of that realization. It's not just a trade for 12 to 18 months. This is a step change, and we're talking about the next 5, 10, 15 years of investment that will come through, and with that, stronger European defense industry, higher returns, and less reliance on other markets. And actually, that setup in itself is quite interesting. But we are being quite selective and very targeted in the way we're expressing it in the portfolio.
Yeah, thanks. And I think with that, we'll draw a close to questions. But thanks, Stefan. I think you've helped our viewers see that there's quite a bit more to Europe than perhaps they suspected if they hadn't looked at it in a while, and that this is a little bit more than just a short-term trade with some really fascinating companies in your portfolio. If you want more information about that, then Greater European Trust has an excellent website with plenty of commentary and information, and likewise Kepler's Trust Intelligence website has plenty of information about this trust and others as well. This presentation will appear on our website shortly, and you'll be able to download the slides that Stefan talked to as well. And with that, I thank you, Stefan. I hope to see you again soon, and to everyone else, we'll see you on the next one.